Hello, everybody out there in core land. Had a little earth, wind, and fire for your bumper rotation. Jeremy, the thing that killed me when I first heard that was how tight the horns were. I mean, that I don't know how they do that. It just absolutely blows me away.
It's amazing.
So joining us today is the infamous, notorious, not the Excel Queen, Jeremy Doorn.
Yes.
Jeremy, welcome.
Thank you. Thank you for having me.
Absolutely. Jeremy is an enrolled agent with the IRS and also a licensed investment advisor with Core Wealth, and has had a lot of experience with this subject. And we've got a lot to cover, so we're going to dive in and get after it. Couple of housekeeping notes. This is being recorded, so don't say anything or ask any questions. You don't want to live on the internet forever. And use the chat or ask a question, and we will get to your question as soon as possible. We'll also have Q&A at the end. But if you have a question in the meantime, please raise your hand. All right, so we're going to talk about qualified plan accounts, which otherwise known as retirement accounts. Anything that you get a tax deduction for, we're calling qualified. So, Jeremy, let's kick it off.
Yeah, so we're going to start. We're going to start with the most simple, the most basic retirement plans, which is the individual plans. So there's essentially three different types. There's the traditional IRA, the Roth IRA, and the SEP IRA. The traditional IRA is a tax-deferred account, which means that you get the tax savings now. So you can make a total contribution of 100% of your earned income, or $6,000. That gets bumped up to $7,000 if you're over 50. All right. Were you going to say something?
No. That was just me monkeying with the computer. Sorry, go ahead.
Okay. So basically, if you make $6,000, $6,000 or more dollars, you can put $6,000 into your traditional IRA, get a tax deduction for it right now. It grows tax-free, and when you turn 59 and a half or retirement, you can pull it out as lump sum or over your retirement time, and it's going to be taxed at ordinary income, the lump sum, once you start pulling that out at retirement. Next, we have the Roth IRA, which is a post-tax IRA, so that these are after-tax dollars, so you're going to pay tax currently. Again, you have to have earned income of at least $6,000 because you can put $6,000 into the Roth IRA. It also goes up to, there's a catch-up contribution of $1,000 to $7,000 if you're over 50. So basically, you would put that money in. You don't get any tax savings now. But then when you turn 59 and a half, and we're pulling the money out for retirement, the distributions are not taxable when you pull them out, as long as you make those after age 59 and a half.
One of the things I really like about the Roth is that there are no required minimum distributions. So you want to talk about an RMD?
Yeah. So when with the traditional IRA, if you stick it in there pre-tax, eventually the IRS wants you to pay tax on that money. So at age 72, if you haven't pulled it out, if you have retirement accounts, they make you take what's called the required minimum distribution. So you have to start taking it out at 72. With a Roth, since you've already paid the tax on it, it grows tax-free, and then you never have to take it out. It can be, so what I'm looking for, it can be passed on to beneficiaries and everything else. So that is nice. There's also another nice thing you can do with the Roth IRAs. One of the tax strategies that we use with sole proprietors is paying minor children to perform work in the business as a tax deduction, because it's not subject to any sort of payroll tax or income tax if you pay them under a certain amount. So since the standard deduction now is $12,000, you can pay a minor child, if you were a sole proprietor, you can pay a minor child $6,000 and put it into a Roth IRA for them. and have that start growing, because they obviously don't have any tax rates, so you're not paying any tax on that money. Put it into a Roth IRA for them and have it saved for college, or save for retirement, because the Roth, you can pull out the actual contributions to the Roth prior to retirement. You just can't pull out the earnings. So if you weren't sure if somebody was going to go to college, if you didn't want to use the 529 plan, a Roth could do that. Or you could just start a Roth super early for a really small child, and by the time they were 59 and a half, that thing would have grown to who knows where. So, and it's grown tax-free, and you didn't pay any tax on to get it in there, and when they take it out, they're not paying tax on it either.
Right. So that's completely tax-free. That's a tax-free transaction.
And you're getting and the sole proprietorship is getting the tax deduction for the $6,000 you're giving to the kid as a wage, right? So you're giving them a wage, putting in a Roth IRA. Nobody's paying tax on any of that money, and you're getting a tax deduction. So you're actually coming out ahead.
And as a sole proprietor, you don't have to pay any payroll taxes on that $6,000 either.
No, it's a beautiful thing.
Yeah, that's completely tax-free. You don't get a lot of those. But the flip side is you could still do that in an S corporation. You're just going to have to pay the payroll taxes, but it's still a good deal.
It's still, because the tax rate of paying just payroll taxes, because their individual tax rate, their income tax rate is probably going to still be 0. So the payroll tax rate is whatever, 8.6, whatever it is.
Well, it's 15.3 if you count both sides of it.
Both sides, but yeah, so that's not too bad. By the time they're retired, it might be in more of a tax bracket than that. So great little thing to do there with the Roth IRA. Very powerful tool. Next, we'll talk about SEPs. I can't ever remember what this stands for.
Self-employed pension.
Pension, that's what I thought it was. Okay, so a SEP is for if you were trying to put away more than $6,000, because you can put away 20% of your net self-employment income. So if up to $56,000. So if you had a really profitable sole proprietor, or if you could still use this in an S corp, you would just have to pay yourself a salary that was you could only do 20%. If 56 would have to be 20% of a pretty large salary if you were in an S corp making that kind of money. But you can stick bigger chunks of money away with the SEP. So it just depends on if you're starting out just trying to save, trying to get in the habit of saving, a traditional or a Roth, depending on your tax situation, might be a good start. But if you're really trying to put loads of money away, a SEP can be a great option.
Right. But when you get into a corporate entity, then we've got some other alternatives.
Yeah, well, and a SEP too. So you have a SEP. So this is an individual SEP, which would be for like a sole proprietor, just one person working in the business. But you can actually have a SEP with employees, but it gets really expensive. So, or it can get really expensive, because if you have a SEP and you're giving yourself 20% of your wages into the 401k, you've got to give all of your employees 20%. So it tends to be get kind of expensive. So it really only works for like sole proprietors or just single person entities. So then we're going to get into the company plans. First one is a simple IRA. That one, why does it keep going black?
Don't ask.
Huh?
I'm technologically challenged.
That's true. All right. So the simple plan, like the name says, it's a simple IRA. You can cover basically all the employees. You can kind of exclude some here and there if they really don't make. If they make at least $5,000 a year, it's pretty hard to exclude anybody. And there's no administrative costs. It's pretty simple to set up. The amount you can contribute, any employee can contribute, is up to $13,000. The catch-up contribution there, if you're over 50, is $3,000, so a total of 16. And then basically the company just throws in a 3% match, so up to 3%. So if you put in 3% of your money, company will put in 3% match for you. So it's a nice little plan. Like I said, there's really no administrative cost. There's not a lot of flexibility with it either. So like the name says, it's simple. It might be a good place to start if you're just trying to get into putting away some money for retirement and don't want just the $6,000, and the SEP doesn't really work for you because you've got a bunch of employees. This is a nice little benefit for the employees as well. All these company plans benefit the owner and benefit the employee as well, right? So I had a client call the other day and was asking about 401k, and we'll get into it later about plan design and stuff, but a lot of times these company plans can be attractors for new employees, good new employees, and for retaining good employees. So it can work both ways. But again,
let me ask you a question. So
yeah.
just to contrast a simple to a SEP, because you said, the SEP is 20%, and that's actually a company match, that 20%, right? And so in the simple, it's a salary deferral. And that's why it doesn't have to be a higher salary and pay higher payroll taxes. You could pay yourself $7,000 and defer all of it.
Yeah,
if that was all the wage you had.
Yeah. So it's a little bit more flexible than the SEP. The SEP is, again, it's for one pop shops that have a lot of money coming through them. And it's hard. It's just more difficult to put that much more money away because it's a percentage, and you just end up paying a whole bunch more in payroll tax because you've got to hike up your salary, or you have a whole bunch of self-employment tax from self-employment income.
And you got to pay your employees more.
And everybody should want to do that, right, Christian?
Right.
Yes. All right. So next is, we'll wait for 401k. I should have put these in different order, but the single 401k is the third one. That's basically a SEP, but as a 401k. Same kind of rules there. You can stick $19,000 away as a salary deferral, $6,000 catch up there, so $25 total. Total you can put away is $56,000, I believe it is. But again, that's just if you don't have any employees, because if you give yourself, a big portion of your wages deferred into the plan, then you've got to give the same percentage to the employee. So if you have employees, single 401k is probably not a very good option for you, or it can get quite expensive.
So the single K you can only do if it's a sole owner or a husband and wife, right?
Yeah, you can do it. Yeah, if you're husband and wife, it would still count as. And with that, it's kind of, so the 401k has not a lot. It has admin costs. It has to file its own. It's got to file its own tax return. It's got to operate under ERISA rules. It's got all these different admin things that have to happen with the 401k because there's a lot of administration that goes on with it. Single 401k is basically like setting up a SEP. It doesn't really have any admin costs as far as it doesn't have a tax return to file. It doesn't have all these other testing and all these other things that have to go along with it. ERISA doesn't typically apply to it. So it's easier to manage. And again, it's a step up from the simple because you can put more away in it, right? So it's all about what you're trying to accomplish tax-wise, and then how much can you put away? I mean, if you can't put a whole bunch away, maybe it doesn't really make sense to get into a single 401k, right? So maybe just starting out with the traditional. So the 401k and the defined benefit plan kind of go together. They kind of piggyback each other. Defined benefit plan is basically cash balance plan. We'll look at that later in a little bit more detail. It's like an old school pension plan where there's money in there for you, and then at retirement you can start pulling it out, right? So you just put cash in there, and there's a defined benefit at the end for it. So that kind of piggybacks on 401k. So 401k is, of all of them, obviously has the biggest limits as far as how much an employee or any one person can put in as far as a deferral of their salary. It's $19,000. If you're over 50, it's $6,000. And then the 401k, like we said, has admin costs, but it's got a lot more flexibility to it. We can add profit sharing to it. We can add the cash balance defined benefit plan to it to really maximize the owner's contributions and how much is going into the plan for the owner. And through, safe harbors in different ways, we can kind of discriminate against all of the employees and really put big chunks of money into it for the owner, depending on the census. So there's a lot of things that go into how much can actually be put in, but it's very flexible. It's got a lot of different options. to it. So it's really nice to be able to use for tax planning, because there's really some big tax expenses that can come out of the 401k. So if you've got a service business and everybody's always talking about end of year tax planning, oh my gosh, I got to go buy some equipment. Well, if you're a psychologist making a ton of money, you're not going to go buy a bunch of big equipment. Like, you don't have anything to really go buy, right? So where's the big tax deductions coming from? Well, there's some that you can do with this 401k if you've got, the right census and have everything set up correctly. So there's a lot you can do with plan design as far as benefiting owner.
All right, so next we have the CARES Act.
I thought I would touch on the CARES Act before we take a deep dive into some of the 401k things. The CARES Act just came out with this whole COVID thing, and it allows you to take out of a qualified plan. So any one of those plans that we just talked about that you might have, you can take out is it called a CARES distribution or a COVID distribution?
I don't think there's really a name. I think people are calling them like CVD distribution.
Yeah, like they're calling them something, but whatever. So you can take out $100,000 up to $100,000 if you qualify, which qualifying is like diagnosed with COVID, taking care of somebody with COVID. Like, if you were breathing on the planet for the last 4 months, then
pretty much everybody,
right? You might check the rules if you're, but yeah, you do have to qualify, but it doesn't seem like it's very hard because it's pretty open, and this thing has pretty much affected everybody, I think. So it shouldn't be too hard, especially when they close schools and everything else. But basically, you can take it out, and if you take money out of these plans before retirement age, there's a 10% penalty, right? So you have to pay 10% penalty, plus if it's in one of the tax deferred plans like an IRA or a 401k, you've got to pay income tax on that money when you take it out. But so they're waiving the penalty, the 10% penalty for you to take it out. And if you pay back the money, then you don't have to pay tax on it. So you're basically taking out, like it says here, a tax-free loan. There's some real, it sounds good, but when you start talking about how you have to pay it back and when you have to actually pay the tax, it gets a little weird. So you don't get surprised if you go and take out, let's say, a $30,000 loan distribution, whatever they're calling this, COVID distribution, and you plan on paying it back. Say you pay it back before your next tax return, then it's fine. You don't have to claim the $30,000 on your tax return. But if you don't pay it off for, let's say, 3 years, because you don't have to pay it off till 3 years from the date you got it, well, you now have to either take the $30,000 in that first year, or you can split up the $30,000 in the next 3 years and pay tax on the $10,000 as you're filing returns. And then when you pay it back, go back and amend those returns to get your money back. So you kind of have to front the taxes, but you'll get them back. So so you're just going to. It
sounded better when Congress wrote it, but after the IRS got involved, it wasn't as exciting.
Yeah, the payback thing kind of throws a wrench in it, I think, because it's like, well, that's all fine and well. If I could have just floated the $30,000 and paid it back in 3 years and just like not put it on my tax return until I decided what I wanted to do, that's probably a better option. But now you're talking about paying somebody to amend returns and all this, but.
So one of the things you and I were talking about is how you might be able to leverage this if you were ever considering converting your regular IRA to a Roth IRA. So, if you have a regular IRA and you take the money out, you got to pay tax on it. And if you're under 59 and a half, you got that penalty on it. Stock markets come back up, but 60 days ago when the equities were all down, you have a lot less in there. You take it out and you're paying less tax. The penalty is waived, and now you can spread that out over 3 years rather than have to pay it all in 1 year. And then you've got it in a Roth and you don't ever pay tax on it again. That might be an outlier case, but it's worth noting.
Well, and I think, if you're talking about looking at some of those IRAs and converting them to Roth IRAs, in a year where the market's down, if you do own a business, you might have lost money this year. So it might be like a triple whammy of there's no penalty. I have losses to offset that ordinary income that I'm going to have to take on there. There's no penalty, and I can pay it out over 3 years. So it might be something to look at. I mean, if you've got a really big IRA, it might not be, but.
I have a question here. And so which is the best plan for a self-employed couple with an S Corp who are way late in the game? Do you have a general answer for that?
Way late in the game.
I'm assuming that means older.
Yeah, well, I assume they need some serious retirement savings. I would say most likely the 401k is probably going to get you there the quickest. The solo 401k might be something to look at because there's not going to be any.
So if they didn't have employees, the solo would work, and if they did, then.
Yeah, and then the solo would work. But if you were, I mean, I don't know how. I think you can do the cash balance plan completely separate, right? So you can have a solo 401k and do like a cash balance defined benefit plan.
I think so. So let's use that as a segue into plan design.
Plan design. So here we go. So again, with a 401k, it's very flexible. There's a lot of different things you can do. There's a lot of ways you can benefit owners. I think if you're giving any match to employees, that's obviously a benefit to employees because as I tell people in enrollment meetings that there's no such thing as free money, but a 401k plan provides free money. Like all you have to do is put in your money and this company is going to give you money. Like it's kind of a no-brainer. So it's going to benefit the employees. So to the most that we can benefit the business owner, great, right? So some of the stuff you can exclude part-time people. You can set the date of service that you want for people to enter. So they can enter in right away when they're hired. You can have them enter when they're 3 months, at 6 months, at 1 year. So it just depends on your workforce. I think some of like the more blue collar places have like 1 year of service just because their turnover is so high that you don't want everybody just coming in and spending 3 months and getting on it and then getting out. It just becomes a nightmare, and it kind of helps retain people for a little bit longer. Some of your more white collar stuff, some of your service businesses are, it might be immediate or it might be like, there's a grace period of 3 months and then you can get in. But that's all within the plan design. So you can design it however you want. You can exclude people that are under 21, union employees. Some of the advantages that you can set up too is the loans. Like we just talked about with the CARES Act, it's basically lets you take a loan out, but you can also set up a 401k because everybody falls on hard times, right? And so you can set up within the 401k for employees, including yourself, because you would be an employee if you were a business owner. You can set up to where you can take out a loan against your 401k. It doesn't count as a distribution. You don't pay the penalty. You don't pay tax on it. And then you basically pay yourself back through payroll with interest. So you're paying yourself interest and putting it back. So that's a nice little thing in there that you can't do with simples and you can't do with IRAs and you can't do that. I mean, you can do it right now because of the CARES Act, but typically within a plan, You can't do that. So it's nice to have that in there. Another thing with the 401k is we add what we call profit sharing to it, which is optional every year, but that's how we kick owners and other beneficial people up to $56,000 a year that we can put in for them, depending on how much they pay themselves and a lot of other different factors. But and it's completely optional, but you can also put a vesting schedule on that. So to discriminate against everybody and put big numbers towards the owners, we have to give it something to everybody that is in the plan or that qualifies to be in the plan. So you got to give something to everybody. There's all kinds of different formulas that go into that. I don't even know all those, so I'm not going to pretend like I'm a math whiz on that. But they figure out what that percentage is, and then you have to give that to all the rank and file. Well, you can do a vesting schedule so that if somebody gets a profit sharing distribution into their account, well, you can make it so like the first year they're 20% vested. and then the next year it's 40%, and then 60 and 80, so that if these, so you retain these employees longer so that they're not just leaving and taking all that money that they just earned within those first couple of years and moving it to somewhere else. So it really helps people to maybe stay around a little bit longer if they want all that money. Obviously, any money they put in and any money that, typically any money that you have as a match, those are typically 100% vested. Employees portion is always 100% vested. You can do a vesting schedule with the match, but typically don't see that because it's just not worth it.
So tell us about the safe harbor.
So safe harbor, that's kind of what I'm talking about when you do a safe harbor match, which means that you can basically discriminate against the employees. So if you wanted to stick in $19,000 in deferred out of your salary into your plan, and say you only had like 2 employees that wanted to put money in, and you just had a regular match, well, they probably wouldn't be putting in a whole bunch. So you would own more than 60% of the plan, which then it would become top heavy, and then you can't put in that much, then you've got to pull it out, and there's blah, blah, blah. So what you do is a safe harbor match, which is, there's a couple of different safe harbor matches, the most popular one being the company will match 100% of the first 3% and 50% of the next 2%. So basically, if an employee puts in 5%, the company will put in 4%. That's one of the safe harbors. There's another safe harbor it has to be at least 4%, but it can go from 4 to whatever, 25%. So you can do any of those, but you just choose the safe harbor, which then means that I can stick in my 19,000 whether or not anybody participates or whether it's top heavy or not. So top heavy thing kind of gets thrown out with that.
Yeah, and I'll point out there that you're talking about a 4% on the 401k versus a 3% on the simple. So it's pretty comparable. I mean, it is more, but it's very similar.
Yeah, it's not much more.
All right, so let's look at an example.
Yeah, so here's an example. I've got, this company has 6 owners. You can see all at the top. Each making $100,000. They've got all the rank and file below there. They all defer the $19,000. This safe harbor happens to be a 3% safe harbor match. So they're going to put in the $19,000. The company's going to put in the $3,000. Same with all the employees below there. Like I said, we can do the profit sharing, and the profit sharing is something that's completely optional. That's what I like to tell people. And I think that's one of the things that is so awesome about the profit sharing is you put it into the plan, and if you have a good year, you can use it. If you have a bad year, you don't have to do it. You're not locked into doing anything. But like you can see here, we can get these owners, because they only made $100,000, we'd have to kick up their earnings a bit to get them to the full 56. But we can get each owner to 47. The bottom ones are over 50, so we got them to 53 with their catch-up contributions. And if you look at the total profit sharing, so to be able to do that profit sharing, the $25,000 for each one of them, we'd have to give the rank and file a 5% of their gross wages, which translates into, we can have a tax deduction of $161,000. Well, go back up. Plus, or go back, whatever. So plus the safe harbor match was another $25,000. So you're talking $185,000 tax deduction in the business.
So 185, of which 168 goes to the owners.
Yeah, 90% of this plan is owned by those principals. So that's pretty awesome. So they're basically putting money away for themselves, a ton of money away, and getting a huge tax deduction for it. And I mean, you have to give something to the rank and file. That's
and you know, the way I like this, that, you know, does the after tax cost. But the thing about that I look at it is, well, okay, you're at a combined tax rate of 30%, say, between federal and state, or just for round purposes. So you're giving up 18 grand to save 30% of this number. And, you know, you're paying your employees, which is a lot better than paying the government. So you know, a plan design like this, you know, as long as the the cash is there is a no-brainer.
Yeah, well, and that's the thing. And I've had conversations with I've had with prospects where they had a 401k in place. They had profit sharing in place. Well, they told me they had profit sharing in place. I don't know if they did. They might not have. But so at the end of the year, to make sure they didn't have any money in the business, taxable income in the business, they would give everybody bonuses.
Mm-hmm.
And I'm like, okay, if you don't need that money, you're paying payroll tax on all of that.
Mm-hmm.
You can literally do the profit sharing thing and accomplish the same exact thing and not pay the payroll taxes on it. And they just were like,
thought you were a genius.
Like, what, really? And I'm like, yeah, really. It's a beautiful thing. It all depends. There's a lot of things that go into these calculations. So it depends on, the rhyme is always, it depends on ages and wages. So it depends on the age and wages that you pay your employees and how old they are and how old you are and what you pay yourself. So they don't always work out like this 401k illustration, but I mean, if they do work out like this is a no-brainer if you've got the cash.
Right, and you'd be happy to get a illustration for anybody at no cost, and you can see what the dollars are for your company.
Yeah, and we can see how we can, change it around and see if we can maximize it out for the owners for sure. Yeah, anytime.
So the ages and wages is a great transition into the defined benefit.
Yes, so there's defined benefit plan. I'm not as familiar with this. I mean, I know what it is, obviously.
You're not an actuary?
I'm not an actuary. But this one, so you've got the 56 or 63 or whatever it is that you can put in with the 401k with the profit sharing and everything else. If you still are wanting to do even more or can do even more because you have cash, the defined benefit plan or cash balance plan, as I like to call it, is can be 6 figures worth of money that you can end up putting away. So, but the problem, that's probably a bad word to use, but the catch here is that when you sign up for the cash balance plan, unlike the profit sharing stuff, if you're going to do a cash balance plan, you've got to do it for at least 3 years, says the IRS. So, and you're locked into certain amounts. So you don't get to choose whether you do it or whether you don't do it. You've got to have some pretty good cash flow to make sure that you can keep this open for at least 3 years. But it can be pretty powerful, and it can be lots of money that you can end up sticking away.
Yeah, I've seen $300,000, $400,000, $500,000 deductions in a year with 90-95% going to the owner. As a matter of fact, we were meeting with a client this week who had one of these plans and was now at the point where they were retiring and taking the money out. And they were like, this was a godsend. This is the most brilliant thing I've ever seen, because, they were able to save a lot of money, save a lot of taxes when they were profitable. And now when they're ready to retire, the money's there. I want to highlight what you said about the consistent cash flow. That is one of the things that I think is a drawback here, is that it is so you can basically, the way it works is the actuary comes up with the amount that you're supposed to contribute for the plan based upon the ages and wages of the participants. And you have some discretion of whether you overfund it or underfund it in a given year, but you don't get a lot of wiggle room. And I've seen businesses that did it when it was the chicken years, and then the feather years came and they were in trouble. So it's not one that you see a lot of businesses do, but if you've got profit and cash flow, there's nothing like it.
No, and I think if you don't make the contribution, it's like an 8% penalty or something, right?
Yeah, it's stupid. On it. Well, so show them this one.
Yeah, so this is not the same business as the last one, but this is another cash balance illustration that we did there was a one-person owner and 2 employees. And so, she pays herself $112,000. She defers $19,000 and gets her safe harbor. They didn't put any profit sharing in here. I think the plan that she was on didn't even have profit sharing. We were actually doing this one completely separate of her 401k plan, which I now have. But so then with the cash balance plan, we can stick in $110,000 for her and stick in $745 total for her 2 employees. So
Yeah, that's kind of stupid, right? 96%. I think this is a great illustration, and I'm glad you used it because this highlights the companies that it is best for. So a lot of professional services firms that have high compensation, older owners, and not a few lower paid younger workers. That's the ideal
typically
sweet spot.
assistants or something like that, somebody that's not making just a ton of money along with everybody up at the top. And so, I mean, you're talking that cash balance plan contribution to $110,000, $111,000. That's a straight deduction from their income. I mean, that's $30,000 savings right there in taxes.
Yeah. All right. So let's talk investment portfolio decisions.
All right, let's do that. Let's talk a little strategy, right? So within these accounts, you've got to decide how you want stuff invested, right? So typically, you don't put this money into cash because cash doesn't really do anything.
You could.
Well, you could, but cash typically loses value because of inflation, and so having some sort of return on your money is probably a better idea than not. So our investment strategy really goes to diversification. I don't know what 8 billion people on the planet are going to do tomorrow. I don't know if they're going to choose Pepsi or Coke. I don't really care if they're going to choose Pepsi or Coke. I'm just going to own it all. And along with that, timing the market. I don't know
when there's going to be a pandemic.
I don't know when there's going to be a pandemic. I don't know when the market's going to go up. I don't know when the market's going to go down because you know what? If I knew where the bottoms and tops of some of these things were, I would be a bazillionaire. Like there's no reason not to be a bazillionaire if I knew where it was at, right? But nobody knows. There's guesses and there's speculation and there's all this stuff. Typically, I don't think it really works. This is kind of a boring strategy compared to some sort of day trading and trying to pick the next Apple to hold on for the next 50 years and make a whole ton of money. Maybe we can pick a CBD company and go chase that for the next 30 years and see if they're going to be the next Apple. Why? There's no reason for that. So we choose portfolios and investing on risk tolerance. So how badly, like how much risk are you willing to take? Some of that is based on age. I know the old adage of, well, if you're young, you can take all kinds of risk, and if you're old, you shouldn't take any risk at all. Well, there's older folks that don't mind taking risk, and there's younger people that don't want to take any risk at all. And so you've got to really match up the design with what people are willing to see on paper. Because if you're 30 years old and you've got a portfolio of $100,000 and next year it loses $45,000, is that going to freak you out? You're not going to touch that money for another 20 or 30 years. If that's going to freak you out, I don't want you in a portfolio that's 100% that even stands a chance of doing something like that, right?
Right.
So we've got to line up your decisions based on tolerance. Another thing we do is rebalance, which is super important. It's quarterly. So we'll talk later about the asset classes, but each portfolio has its different asset classes: large cap, U.S. large cap, foreign large cap, all these different asset classes. And throughout the quarter, throughout the year, one asset class is going to do really, really well. So maybe U.S. stocks are just going crazy, so they're way up. Well, the portfolio is designed to have 25% large cap U.S. stocks. Well, now because they've done so well, they're up to 30 or 31%. Well, what are you going to do with that? You can't just keep letting that go. So we do what you're supposed to do in the stock market, which is sell high, sell it back down to 25% or whatever that allocation percentage should be, and buy low, which is, some of the other buckets aren't doing as well. We go and buy those and buy them back up to what their allotted percentages are supposed to be. So that's super important because that's kind of how the stock market works. So along with the diversity thing and the balancing and everything else is low cost. So the funds we use have very low expense ratios within them because they don't have a whole lot of chasing the next big
Active trading is expensive.
If the only people making money on that are the people that are doing the trading,
Yep.
right? So that's not cool. And so we go to this quilt. We call this the quilt, and it's a great representation of if somebody knows which one of these asset classes at the top of the slide here, if somebody knows what's going to do best this year or next year and can tell me the pattern in here, I will give them $1 million because there is no pattern here. So you can see that there's absolutely no timing. How are you going to know which one's going to do best the next year? Look at 17. 17, who is this? U.S. aggregate bond was the worst performer. So why would you go buy that? Well, in 18, if you didn't go buy that or didn't have it, you lost out. They ended up
Everything else lost money.
Everything else lost money. So if you went in 17 and went, oh gosh, I got to get out of U.S. aggregate bond because it's terrible, and look at, oh my gosh, I've got to buy emerging markets. You just went and did what? You just went and lost the best performer the next year and, fourth to the worst.
Same thing right here. Look at this emerging markets. This would be your third world countries and the like, second world countries. Yeah. Lost 50% one year, gained 71 the next.
Yeah, and you know what people did at the end of 2008? They went, I got to get out of this emerging markets thing, and guess what happened? They left a whole bunch of money on the table. There's no timing this thing. This is another one that shows people that, so a lot of the stuff that we do is long-term retirement investing, right? So if you're in it for the long term and you're freaking out about everything short term, these are slides that should give you some comfort knowing that you're not going to touch this money for a while. These red dots show the inter-year lows.
So this is the lowest it got during the year.
During the year, it lost that much.
And this is the gray bar is where it ended.
Where the overall year ended. So like I think this last year, that's 2017, but this one here with the 30% return, that's probably like 2012. No, over here on the right. No, fifth one from the far right.
Oh, bollocks.
Well, you can use that one. So at whatever year that is, 2011, at some point the market lost 10%. So if you freaked out and sold it and weren't in the market the whole entire year, you missed out on 13% gains that year.
Yeah, I think this is the one you were talking about, 28 to 23.
Yeah, so you've got that's in 2009, right? So you've got the market dropped 28%, and what do people do? Run for cash. I'm out of here. Well, if you don't take the good with the bad, you can see most of these years. How many years are losses? 1, 2, 3, 4, 5, 6, 7, 8 years out of 37 years are losses. So
great point.
Exactly. So another thing that investors or investment advisor representatives like myself do is, like we just showed, talking people off the edge, talking people through the investment noise that's on MSNBC or any of these other channels that's, oh my gosh, this is the next big thing, you got to get in this, or you got to get out, the stock market's going to hell, whatever. This right here shows, so in 2006, if you had $100,000, this shows that through this crash, what do they call it in the 2008 Great Depression?
Second Depression, I don't know, whatever. Great Recession.
Whatever the name was. So if you got out near the bottom, or you got out there in 2009 and just got out into cash, you would have had $55,000. That's the green, right? So if you just got out and didn't get back in, that's $55,000. Okay. You would have lost 45% of your money, and you would have locked in that loss, right? If you would have gotten out and then got back in because you knew exactly when it was going to go back up, right? Because we all do. No, we don't. But if you would have gotten back in a year later, then it would have gotten up to, by 2018, it would have gotten to $155,000. So now, all right, so you're back in positive territory. But if you would have done nothing and just ridden it out, what is this? 10 years later, you would have been up $138,000 if you would have just ridden it out and taken the bad with the good. So
Do you know how many people I had call me after President Trump was elected, before he was even inaugurated, saying, "I got to get out of the stock market. It's gonna collapse." And then, for 3 years it just went up, and I'm like, I don't know what to tell you.
And it doesn't matter, even if it goes down. Even if it goes down, I always tell people that call me asking me to put their stuff into cash, I always ask them, has something changed about the way you're going to retire or when you're going to retire? And if the answer is no, then we trust the situation and the portfolio and what we're doing. So just trust it.
Trust the process.
You don't need to change anything, because the second you change something is the second you leave money on the table. So.
All right. So strategy by account type. So this kind of goes back to the whole pre-tax, after-tax.
Yes. So the pre-tax is so if you're in a high tax bracket now, and you expect to be in a lower tax bracket maybe in retirement, then traditional IRA might be better for you, because you're deferring the high tax rates now, pulling it out when you have a lower tax rate. Roth, completely opposite. If you're in a lower tax rate now, typically younger people, people that don't make a whole lot of money, a Roth can be a good option, because then you pull it out tax-free when you're making more money in retirement. Another thing with the Roth that I forgot to mention earlier is the Roth, there's just a gross income limitation, so you can't contribute to a Roth once you make a certain amount of money. So
unless it's in a 401k.
I know, that's what I was going to say. You can also add that Roth 401k, which I didn't have in here either, that you can add a Roth 401k, so then you have the same limits as a 401k, so you can put in the $19,000 into the Roth. The only problem, well, not the problem, the only stickler with that is that all the matches have to go into a regular 401k, because the company can't put into a Roth 401k for you, but you can still put in, and there's no gross income limitations for that. So, and then the non-qualified accounts, those are taxable accounts. Those are like investment accounts where you're just investing. Those aren't in any sort of retirement or tax deferred, anything like that. So you're actually having to take income or losses as you go. So sometimes, like with the rebalancing and everything else, you're going to have some losses and some gains. You're also going to have to pay dividends and interest throughout the year for those ones that pay that. Those you can use for what they call tax harvesting, I think is what it's called, right? Is that what it's called?
Right. Yeah.
Gain harvesting. So if you have, you don't want to have a whole lot of capital gains losses, because if you don't have any capital gains to offset that, you can only take $3,000 at a time. So if you go run a big old loss, then you've got to take it $3,000 at a time. So if you have those,
I see this all the time with day traders, right? They ride a stock market up and they're making money hand over fist, and then they lose it all the next year, and they're right back where they started with their dollars, but their taxes are completely screwed, because they had to pay tax all the way up, but on the way down, it's stuck at $30,000 a year. I mean, I see this all the time.
Yeah, and so you can go into some of these accounts, and if and I mean, day traders are a little different, but if you had somebody that had a bunch of loss carry forward and was taking $3,000 at a time, if you had a stock that was super appreciated in an account, you could go and sell that and take the gain on it to wipe out some of those losses and not pay the tax on it, and you'd get a step up in the basis. So then you would step up how much that stock is worth now. So now you've got a stepped up basis, and you've taken out all the gain and not had to pay tax on it. So and
that's the other thing I would highlight is that unlike the qualified plan, you can take advantage of the capital gain rate, which currently is lower and historically has been lower. So, if you have stocks, let's just say you had stocks and bonds, and that's it. It would probably make more sense, and it's a complicated decision, but probably make more sense to put your stocks in a non-qualified account, take the capital gains rate on the way up, and then put your bonds, your ones that are producing interest and dividends every month, a quarter, a year, into your qualified plan, because that's ordinary income anyway. So there's some factors there to look at the rate arbitrage, as you will.
Yes, for sure.
All right, so let's see if we have any additional questions. Do you have any final thoughts before we sign off while we're waiting on last minute questions?
I do not. No, I think I've talked enough.
You do talk a lot. There's no question.
I feel like I talked enough.
There is no question. All right. Well, I don't see any other questions. Please reach out to us if you do have questions about your personal situation. And I want to thank you, Jeremy. Wave until the camera is turned off. You know how that goes. Wave, keep waving.